James recently celebrated receiving a gold watch for his years at Ford, yet his day-to-day work looks identical to when he started in his 20s. Every paycheck is immediately routed into consumption, funding wild boar hunting trips, expensive gear, and flights. He is working strictly to fund his current lifestyle, entirely dependent on the next salary to maintain it. At the other extreme is Stephen. He avoids the slow grind by relying on massive, high-risk startup speculations, like a company he described as the Walmart of the metaverse. He uses these speculative wins to fund a brand new Tesla and a high-status lifestyle. It is easy to assume these are the only two options. You either accept the lifelong paycheck-to-paycheck grind of James, or you take reckless gambles like Stephen, hoping for a lucky break that allows you to quit. But Tom found a different path. He began his career on an assembly line as a junior mechanical engineer with nothing to his name. Despite having a thoroughly average salary and avoiding wild speculative bets, Tom reached financial independence and retired at age 43. Tom's early retirement resulted from recognizing that building wealth requires passing through specific stages, where the rules for success change depending on the size of the portfolio. This chart compares a 10% market return on a starting $1,000 portfolio, a small $100 gain, against a standard monthly salary. Between $0 and $20,000, agonizing over stock picks is a waste of energy because the market's contribution is statistically invisible. As the chart shifts to include monthly capital injections, the deposits dwarf the investment returns. By following the pay-yourself-first rule and instantly routing 10% of his salary into savings, Tom used his savings rate as the primary engine of growth. He learned this through a painful mistake, initially losing 60% of his capital by speculating on unprofitable nano-biotech companies he found on Reddit. Making a catastrophic error early on has a hidden advantage. Because Tom's total portfolio was still small, his regular salary contributions replenished that entire percentage loss in just 2 months. At the $0 to $20,000 stage, manual labor and basic frugality build the snowball more effectively than any attempt at financial genius. Once the portfolio has some mass, the psychological grind begins. Charlie Munger famously argued that the first $100,000 is the hardest milestone to reach, but getting there is non-negotiable. The primary lever for wealth generation now shifts from pure saving to absolute defense. Success at this stage requires the discipline to let compounding work without unnecessarily interrupting the process. Tom protected his momentum by declining a parent-funded down payment on a house, which he viewed as a liability, and by passing on Stephen's speculative metaverse opportunities. Instead of chasing high-status hype, he pivoted to companies he could easily understand. He studied the numbers and purchased shares in unglamorous, everyday businesses with proven cash flows, like Walmart. The crucible stage is a test of patience. It involves ignoring the temptation of lifestyle inflation and focusing entirely on building an unbreakable foundation that can eventually support itself. This line graph maps a specific mathematical tipping point. At $100,000, the curving trajectory of compounding portfolio returns finally crosses and overtakes the flat line of Tom's annual salary contributions. Then the ultimate stress test arrives. The stock market fractures, dropping by more than 50% in a single year. Surviving this collapse requires a contrarian mindset. As Benjamin Graham suggested, you should buy stocks the way you buy groceries, not the way you buy perfume. A market crash simply puts exceptional companies on a massive discount. While his colleagues panicked and sold their holdings, Tom aggressively bought into the fear. He capitalized on the sale, picking up high-quality businesses that other investors were desperate to get rid of. Those discounted assets fueled returns of 30 to 45% in the following years. At this late stage, emotional control during volatility does more to cross the $1 million finish line than decades of pinching pennies. Today, Tom is 43 and financially free. Stephen, meanwhile, rolled his initial startup winnings into a second gamble called Starverse, lost everything, and is back working in a cubicle. The core philosophy separating them is that true wealth is exactly what you do not see. Spending hundreds of thousands of dollars on an exotic supercar leaves you with exactly that much less net worth than you had before. It is a visible exchange of capital for a status object. Tom skipped the high-status purchases and bought the ultimate luxury instead. By letting his investments cover his expenses, he bought back 14 years of his own life. Escaping the rat race rests on aligning behavior with the mathematical reality of each stage, protecting compounding and realizing that time is the highest dividend money can pay.